Hello, everybody. This is Dave McShane, Anderson Financial Services. I'm here with Toby Mathis today, and I want to thank you all for attending the webinar. We're going to get into it in a second, but Toby, a lot of you know very, very well. I'm going to let Toby make a couple of comments, and then I'll start unveiling some of the things that I think you all are aware of, but may not have been aware of at the depth that they actually are.
Yeah, hey folks. First off, welcome. We're lucky to have somebody with Dave's experience. I'm sure he'll go into some of that. Somebody with the experience that he has in the understanding of how the financial industry actually works. And a lot of times what we are told and what's disclosed is about a third or half of the story. And what you have to understand is kind of the different terminology. Dave's going to be going over what a fiduciary is and how fees are actually calculated on certain financial products and how you can determine what you're actually paying. It's amazing how often we will see people who have a 401k or an IRA and they are convinced based off of their statements that they're making 6% a year, when with simple math you could figure out, hey, you have a $100,000 account and at the end of the year you have $101,000. You didn't make 6%. But they are fight upside down. Hey, my statement right here, I point to it. It says I made a 6% return. And you gotta, actually figure out how to calculate what it is that you're actually returning. And so with David, we're gonna be breaking it down so you can determine what it is that you're actually paying.
Great. The first slide I thought was kind of interesting. I want to, right off the top, I've been in this business for 40 years. I do not want anybody to think that I'm in any way suggesting that the people in the business that I used to work with as financial advisors, et cetera, that everybody's a crook. That's simply not the case. But I think when we go through some of the fee discussions, you'll find out that at a minimum, the system is potentially robbing you if you're invested in any of these products. So no further ado, let's get going.
I don't know if David, I don't think that they're saying that somebody's a crook. I think that it's more an issue as to whether they're being completely forthright. And I know when we were talking, and we've done this from the stage, we've done this in person, where we're saying if somebody walked up and took $20 out of your pocket when you were on the street, they'd be incarcerated for it. Yet certain financial planners, and I work in a profession, I've been an attorney for almost 20 years. The lawyer can come up and hold you up with a lawsuit and shake you down. A financial planner can take your money without you knowing about it and give you half the story. And there's no ramification there either. And it's just understanding and knowing when that person actually is draining your pocket. And so I'm not saying somebody's a crook, but man, when somebody isn't telling you that they're charging you something, in fact, they lead you to believe that you're only paying a certain percent and they're knowingly doing it, then that to me, they are stealing from you.
Okay. That's fair. And that's, the challenge is regulation demands that they say certain things, certain disclosures, but the regulations quite honestly stop short of what reality is. So we'll go through that. Real quickly, just a few of you have listened to my other webinars, but for those that have not, I am a certified financial planner. I've been in the financial services business for over 40 years. And as you can see from the slide that's up, I've had some very senior roles at some fairly well-known organizations in this country, as well as being a broker at one time in my life, an insurance rep for one of the large insurance companies, et cetera, et cetera. So when I talk to you today, I'm going to be speaking from an insider's perspective of what I saw and things that as a certified financial planner challenged me because it didn't always feel like it was the right thing to do by the client. I'm not a stockbroker. I'm not a financial advisor. Again, I'm a certified financial planner. And because of that, by oath, I am a fiduciary.
What is a fiduciary, David? That's a term of art. So what does it really mean?
Fiduciary is an individual who must do what's in the best interest of the client. They have no choice. And frankly, in our business, that's the way it should always be. The challenge we've had in our business for years and continues to be going on as we speak today is the rule that financial advisors operate under is the suitability rule. And that is that whatever it is that they are presenting to a client, they must be able to, in good conscience, argue in let's say a court of law that the investment that they put them into was suitable. And that's fine and dandy, but a very good salesperson could certainly argue that most products are suitable depending on what angle that you look at it. And here's, if you look at the second definition, the registered investment advisor, as they say, is held to a fiduciary standard, looks after the assets on another person's behalf. So we're going to get into that a little bit today, as far as there's some stuff going on Wall Street, or not going on. That's probably more to the point. That's the problem. But we're going to continue to talk about fiduciary for a couple of minutes, and then we'll get into the meat of the presentation.
I think that they can't see the fiduciary slide, so we'll have a technician get in here and make it work.
Always good to have a techie close by.
So anyway, let's give you guys a visual, since the visual's not working. The easiest way to think about this for a fiduciary is, let's say you go into a butcher shop and you see Luigi and you say, "Hey Luigi, what should I have for dinner tonight?" And Luigi says, what is he going to say? He's going to say, "You should have a New York steak. You should have veal. You should have, I got some really great stuff from, from Japan. I got some really great, what do they eat over there? Really great beef." But the point is that he's never going to tell you to eat a bunch of vegetables and say, "Dave, quit eating all that meat. You're going to kill yourself." It's because Luigi sells what? He sells meat. He's a butcher. So if you want to go to somebody who's going to tell you what's in your best interest, you go to who? In the case of, we're talking about diet, you're going to go to a dietitian or a doctor. And they're going to say, "Hey, here's what you should have. Yeah, you can have a little bit of meat, but you shouldn't eat red meat all the time. Maybe you should have some chicken or some lean red meat or some fish. How about a lot of fruits and veggies?" But that's not what you're going to get from the butcher. Yet a lot of us go and get our financial advice from the butcher. And so what a fiduciary really is the doctor. That's the one that's saying, "Hey, here's the mix." It's no longer are they selling what they have. Another great example is if you go into a Toyota dealership and you ask them what kind of car you should buy, guess what they're going to tell you? They're going to tell you to buy the Toyota. If you walk into Merrill Lynch or you walk into some other financial institution, they have products to sell you. You may not realize it because they have the whole gamut of the universe, but they have the thing that they're going to sell you that they're getting the most money on. If you just flat out ask them, don't expect anything else than what's probably going to be in their best interest. Because quite often, in fact, the vast majority, I forget how many CFPs there are in the country, about 6,000.
A little bit more than that now, but not that many, relatively speaking.
It's a minority of this profession are actual fiduciaries. These are people that can operate in their best interest. And it's not like they're just viciously stealing. It's just you have to understand that they don't have to put your best interest in front of their own. Quite often they're selling you something because that's what they sell. It's like if you go to an insurance agent and you say, "Hey, what should I do for my financial plan?" What are they going to tell you? They're going to tell you to buy insurance. If I go to a guy who sells bonds, what should I do for my financial plan? Don't be surprised when he tells you should buy bonds. If I go to a stockbroker and say, "Hey, what's appropriate for my 90-year-old mom, and she needs to make sure she has it," don't be surprised when he puts her in the stock market and she loses a lot of her money in the tech bubble burst. It's like, that's why these things happen. It's that's what they sell. And so we should just be aware when you walk into the butcher shop, they're very useful for certain things, but don't go and get your general advice. You need to have somebody who's looking out for your best interests. And so what Dave's talking about when he's talking about a fiduciary, that's what he's talking about. So why does that matter?
Well, as you see on the screen, we've got a little cartoon there. It's not very funny, quite honestly. I think a lot of us have felt this over the years. I'm a little more seasoned individuals. So I've seen many stock market ups and the downs, of course, hurt pretty badly when they happen. But the cartoon basically is the advisor sitting with his client. The client's lost apparently a lot of his money, but he still has some left. And the advisor, of course, is looking at him saying, well, really sorry about the money you lost, but hey, let's invest what you have left. And that's the whole point. Brokers don't lose necessarily in these transactions. They make their money in the middle. They make their money by selling a product and or maintaining a product where they get maybe a small trailer fee in addition. So let's look. These are headlines. These are not from years ago. These are from like in the last few weeks when I could have pulled another 5, 10, 15 of them out of today's newspaper and news briefings. So this is about Wall Street. Wall Street is the Department of Labor has determined that it makes no sense in their mind, and Congress is on their side also, saying why is it that retirement accounts are not being treated as the most important thing to the individuals that have them? Why are the organizations that maintain those accounts, sell those accounts, etc., why are they not being run in the best interest of the client? Because at the end of the day, when they hit 65, 70, whatever time frame they intend to retire by, this is all many of them are going to have to live on till who knows when. And Wall Street recently, the Department of Labor passed a new regulation, and Wall Street just said, we're not going to abide by that. We're going to continue to go by the suitability rule. We like that. We think that's appropriate. If our folks do it properly, it's fine. The question, of course, I have coming from a fiduciary standpoint is, why is it fine? What is wrong with doing the absolute right thing by the client? I don't think there should be anything wrong with that. Isn't that what we're supposed to do? But, and I'll tell you the challenges as we go through this in the next few minutes, but here's some of the headlines. As you can see, Wall Street spending millions to quash the new fiduciary rule. Can Wall Street kill a fiduciary rule? Wall Street bristles at new fiduciary standards, so on and so forth. So basically what they're saying is, we don't like your new rule that we have to go and do the right thing by the client. We want to live by the old rules that have been working just fine for us for decades now.
In putting this into English, this means that somebody is actually trying to enact a rule that says you have to do things in the best interest of the client. And the very advisors that sell the product say, we don't want that rule.
Absolutely.
That's got to freak you out a little bit.
Absolutely.
That's like somebody going up to a doctor saying, hey, you have to do what's in the best interest of the doctors. Think about this. They're the ones prescribing medications and everything else. And somebody walked up and says, hey, you have to do things in the best interest of the client. And they fight it and say, no, we'd rather not.
Right.
We'd just rather do a suitability, which means could they handle it?
Yeah. If I give them this drug,
will it kill them?
Will it kill them or not? I hope not. But who knows? We'll try it out and see what happens.
Oh, geez.
And how many of you on the webinar right now have had advisors, perhaps even very well intentioned, but experiment with you, and at the end of the day, it didn't work out so well. And to Toby's point, this is I tend to use a lot of outside sources because I think, and I support what they're saying. So don't think I'm handing off their comments as theirs, and I have nothing to do with it. I support what they're saying. That's why it's in this webinar. But this particular group talked about Wealth Daily. That second notation there, as crazy as this sounds, the fiduciary standard currently doesn't apply to everyone. That means Wall Street brokers can push on their unaware clients poor investments that maximize fees and more likely than not lack any upside. That won't actually be giving investors the good advice they claim to provide.
Does this relate to anybody with the 4010 that's watched their accounts get hammered in the last 6 or 7 years, or who's had the joy of being put into an investment that just went right down the toilet, and you found out that the brokers knew ahead of time that it was going to tank, but they had such an incentive for an upside, and the massive, billion-dollar penalties that some of these firms received as a result, which I don't think, right. Did any of the investors get that money?
No. It's arguably pays for more regulators to go out and regulate. But and a perfect example to what Toby's saying, and some of you may be aware of this, but for those that are not, one of the challenges we were having, the 401k market came out, as we know, a couple of decades ago, and replaced what we knew as the formal pension plan, where my dad, God bless him, until the day he passed, he had a check coming in every month because he had a pension. The 401k was supposed to replace that. Well, what was happening, and what is happening, is retirees are getting to their retirement age and they have no money. Now, they may have used the 401k, so it's not necessarily that they didn't invest in it. They invested in it, but they didn't know what to do with it, so they left it in a money market account. And it's not really grown very much, especially in the last few years where money market accounts are making 1/4%. So now they're retiring and they don't have enough money to live on. And the challenge with that is the government about 5 years ago said, well, what we're going to do is we're going to create a target date fund within these 401ks where they don't even have to think about it. In other words, they pick their retirement date and that's the fund they go into, and the managers manage those funds. So as it gets closer to the retirement date, the manager becomes much more conservative in the array of investments they have in that particular strategy. The problem was the mutual fund companies decided that what a great place to put some of our non-performing funds into. We'll just kind of slide those in because nobody's going to notice the difference because these are long-term investments, these 401ks, until they were called out to Washington and had to testify in front of a lot of folks out that way as to why they were using these things that didn't work. This is the whole point of why they wanted these QDIAs, as they call them, as far as these target date funds, was to make sure that people had money when they retired, not for the mutual funds to go slide in the stuff that they couldn't sell to anybody else. So, we're talking about fees today, and that's what we'll focus on. But just to give you an idea of the sorts of things that go on, and they get called up to Washington, they get fined, and oh well, so what? It's not that they won't do it again next week.
And we watched a ton of retirees take it right on the chin. And we watched retirement accounts get depleted. We're watching more and more people having to work way past what they anticipated for their retirement age as a result. And a huge meltdown occurred. We want to blame it on the mortgage, but the mortgage was only one little piece of that puzzle. And frankly, you got to get out of this stuff. You got to get out of it. There's still a plague on in the financial industry. I look at a lot of these mutual funds, and I think that they're almost a plague. They're just something that's there that people are unwittingly putting their monies into. That's just lining the pockets of people that you don't need to line their pockets. They got enough jets.
They serve their purpose in their day. And when Vanguard came out, it served his purpose because he came out with the low-cost mutual fund. But we also have noticed since John has kind of gone off to the sidelines, even those mutual funds have gained some fee structure they didn't have before.
He's the one who said he's gone on the record. It's not what it was, what he started.
Exactly. Here's our friend Gordon Gekko. Some of you probably remember him. I won't get into his quotes here, but it just ties back into what we're seeing live today on Wall Street. That the heck with the investor. It's all about. I liken it to the Players Association, some of the professional sports. It's all about the player and the heck with the league. Okay. Now, this goes back a little bit in my history, being a senior executive at some of the large companies that I said I was involved with. And every year we go away to our retreat and sit down. And usually the topic, the way it started was, how do we do the best thing by the client? Because if we can figure that out, we can get more clients. And the interesting thing, and this goes back to comments Toby made earlier in our session, let's assume this is yourselves. You're the couple down the bottom. You've got $1 million you're sitting in your hand. And you walk into Big Bank USA, Main Street, whatever town you live in. And you go to the first desk, and the young lady there sells insurance. And she looks at your $1 million and says, you know what you need? You need a fixed annuity. That would work out really, really well for you. And how much, here's the forms, let's sign them. She says, thank you very much. You go to the second desk, and the young lady there selling CDs. Well, of course, that's the solution to what you need to do with your $1 million. You say, thank you very much. You go to the third desk. Young man there selling brokerage products. So he's selling you an asset allocation of mutual funds. Says, I'll take your $1 million and I'll allocate your money and everything will be fine. We walk back to the curb outside the bank and you look at each other and you say, we walked into one institution and I still don't know what we're supposed to do with our money. And here's why. Here's the reality of not just banks, brokerage houses, insurance companies, etc. Each of those salespeople are motivated and compensated to sell a product. If they don't sell CDs and that's their job, not only do they not eat tonight, they get fired. If you don't sell insurance and that's your job, you don't eat tonight, you get fired. So how in the world do you have this silo mentality towards the client saying, if you don't sell that product over there, I will fire you or penalize you by not paying you. And by the way, do the best thing by the client. It doesn't add up. It doesn't make sense. And it's a model that continues to happen every day at your bank down the street, your brokerage house down the street, your insurance company down the street.
And let me go back to the original example of Luigi and the fish guy. This is like going up to the butcher saying, what should I have for dinner? Then you go to the fish guy and ask him what you should have for dinner. Then you go over to the chicken place and you ask them what you should have for dinner. They're all going to tell you different things, but they're going to tell you their product because that's what you'd have. What you need to do is you need to go to the nutritionist, or you're going to be confused as get out, because everybody you're asking, they're always going to sell their product. And another way, if you go look for a car and you walk into the Audi dealership, don't be surprised when they say, for you, this Audi's perfect. When you run over to the Toyota dealership, they tell you, no, the Toyota's better. When you go over to the Hyundai dealership, they say, no, wait a second, the Hyundai's better. You're going to just confuse the heck out of yourself. You need somebody who's actually saying, hey, based off of what you need, and like, let's take a look and really explore how you're going to be using this, etc. This is what's going to serve your purpose, or here's your options. And there may be more than one, but they're giving you at least the options.
I'm a big believer in, there's a Tony D'Alessandro is a doctor that, or doctorate, he wrote a presentation on the platinum rule. And the platinum rule is a little bit different than the golden rule. The golden rule, of course, is do unto others as you want done unto yourself. His perspective on the world is do unto others as they want done unto them. And I think if a lot more of us kind of adopted that approach to life in general, we probably see a lot more successes as we go along. This next slide, I'm not going to get into it because this is stuff you all think about every day when you think about your portfolios. What's the market going to do? Is the equity market going to go up or down? The bond market, how's that going to be affected by interest rates? Taxes are a consideration. Reinvestment risk. If you invested in bonds back in the early 80s, you got a 16, 17, 18% interest rate. What do you get now in your bonds when you buy them? 2, 3, 4. Timing of returns, longevity. I'm working on a social security maximizer program right now with a lot of our clients, and I'll tell you, I'm very surprised, I guess positively, but they are living, their families are living to be 100 years old. Lady yesterday, her mom lived, is still with us. She's 100. Her grandmother lived to 104. Longevity risk is real. Healthcare risk, we all think about that, I think, as we get a bit older, because parts are just starting to fail. Inflation is an obvious. And here's the thing, with all the market things, you wish you could wake up in the morning and have this kind of symbol floating in the air. What this is a taxi cab over in Bangkok, Thailand. When you get into a taxi cab, they got up all these little icons, and it's very clear what you should not do in a taxi cab. You shouldn't smoke. The second little symbol is a durian. It's a very smelly, smells like a dead body, unfortunately, fruit. They don't want you bringing that fruit into their taxi cabs. You can't have a party in a taxi cab. German shepherds are not allowed in a taxi cab. No wrestling, apparently, in a taxi cab. Machine guns and machetes are discouraged. And you shouldn't bring any rams into a taxi cab in Bangkok, Thailand. So, point being, when we look at the market every day, we all wish we could wake up and know where's the crystal ball. But we can't do much about a lot of those things except to do the right thing as far as positioning ourselves as best as possible to preserve our wealth and hopefully prosper. But here's something to think about. What about the cost of your portfolio? We all walk into our different advisors and we accept what they say. We're not always happy about it. We hear 3% bandied about in the media about how much it's costing for a mutual fund, etc. But I want to take a look today. How do these fees, how do they affect your bottom line? And I think you might be a little bit surprised. This was Forbes did an article actually a couple of years back. So quite honestly, the prices are a little bit more expensive than this. But they broke down what's the cost of a taxable mutual fund. And this is where I think you're going to start to feel a little surprise versus what you actually thought you were paying. The first two numbers, the expense ratio, every prospectus that you have to be given when you buy a mutual fund typically runs about 100 pages long, and usually at about page 72, there's a little paragraph and it says, here's what your expense ratio is, which is the cost of them taking care of the fund for you. Then you have the transaction costs of the fund itself, brokerage commission, that when they buy and sell the stuff that's inside your mutual fund, market impact, what that is if they want to sell a bunch of any particular stock, let's say Apple, and the market gets a hold of that news, the first share they sells at $400, the 100th share sells at $385 because the market knows there's blood in the water, so it starts bidding down that particular stock. And if you own that stock as part of your mutual fund, you get affected by it. Spread cost is just the difference between the buy and sell, because if they're selling Apple stock, once they get the cash in, they're going to buy something else. So you're going to pay fees through your mutual fund on both sides of that transaction. So those two, if you add them up, comes out to about, about 2.5%, let's say rounded. Those are kind of the numbers you hear when the media talks about the price and cost of a mutual fund. But here's the additional reality. Tax costs, we think about the appreciation of the mutual fund itself, but here's the thing. If you buy into a mutual fund in September and it's enjoyed some appreciation within the mutual fund earlier in the year, you now have just got the opportunity to enjoy a tax hit that's going to happen because that appreciation will be paid for, and you weren't even there to enjoy the appreciation. So those costs can run 1 to 1.2%. Cash drag, what's that? Some of the more popular mutual funds sometimes have more money coming in they know what to do with. Problem they have is how do they go and invest? So the cash sits in, as cash for a period of time. What does that cost when part of your mutual fund is invested in cash? It costs about 0.8% on average. Soft dollar costs, what's that? Well, let's say your mutual fund company needs to sell some stuff. They go down to their broker and they say, we need to sell whatever. Broker says, okay, be $1 a transaction. They go, well, gee, that doesn't seem right because the broker down the street's only 75 cents. You say, well, I'll tell you what, we're still going to charge you $1, but we'll give you free research because we have this great research department. Now, the mutual fund company, if they agree to that, they get the research, but you get that 25-cent hit that you didn't have to pay had they gone to broker number 2. So those costs people don't see because they're in there, but you don't notice them. Advisory fees, if you have an advisor you're working with, if you're not doing this all by yourself, you're paying anywhere from 0.25% to 2.5%. Let's break it down a little further. Let's look at it again in some different numbers. Expense ratio, 0.9%. Transaction cost, 1.44. Your tax costs, maybe I gave the lower number, 1%. Cash drag is 0.8%. Arguably, your total cost of a taxable mutual fund, based on what Forbes is looking at, it was 4.17%, which is much higher than the 2.5 to 3 that the media talks about. But you really have to add in those other costs, the soft dollar costs, and if you have an advisor, the average advisor fee is about 1.25%. That means for you to invest in a mutual fund through an advisor, on average, your cost is 5.82%.
And just keep in mind, guys, this is the average, which means some of you guys may be below it. Some of you guys may be higher, 6-7% a year cost. Ridiculous. Even if it doesn't make money, you could be getting hit with this. That's how these people, that's why you're sitting there and you're like, why is my retirement plan not growing? The S&P skyrockets. How come I'm not going up? Like I go up, but how come at the end of the year it's 10%? And then when it tanks, I would get all of that loss. And, and at the end of the period, you're looking at it going, wait a second, I got hit with all of the losses and only part of the upside. That's how they're transitioning the money from your account into their pockets. Anyway, keep going.
One of the things that we do here is we use a firm. It's personalfund.com. You can all go and look at that online. You can actually get a trial, and they'll give you about 3 or 4 mutual funds you can go and take a look at, and then they want a fee. We pay the annual fee here, so we can do that for our clients. But this is a very popular mutual fund, the Growth Fund of America. It's just showing in comparison to 4 other options that essentially do exactly the same thing, the difference in expenses. Now that may not look so expensive, the 1.02% for the Growth Fund, but relative to 7/10 or 7/100, in fact that's 7 basis points, 7/100%. That's pretty darn expensive. And as you look down towards the end of the last paragraph, that first fund also has an upfront fee of 5.75%. So 1.02 is really not the number that we need to consider. On top of that, while I use personal fund as a nice way to kind of take a look at people's portfolios, they're not factoring in some of the other things, and I'll show you what I mean in a sec.
Personal fund, that's a program.
It's a website.
Yeah. So you go to the website, you put your fund in, and it'll tell you. Yeah,
you put your ticker in and say, gee, I want to see how my fund compares to options that I could be using if I was using them.
Mm-hmm.
And in fact, what we do here is we do cost benefit analysis for our clients. They'll come in and they'll say, gee, I have a portfolio of mutual funds, Dave. I don't know. I have no idea what I'm paying. Can you help me? So we use personalfund.com. what you're seeing, sample number one, this is a live account. I've taken away the names of the clients, obviously, and the name of the institution, because quite frankly, it doesn't matter, because they're all doing it, if you will. These are the funds that are actually in this person's portfolio. And as you look over to the right, it shows the actual cost of ownership of each of the different funds. And that's obviously based on how much of each fund they have in their portfolio. So a more expensive fund, if it's got a lot of balance in the fund or in their portfolio, is going to cost them much more. But for this particular client, this is an actual representation. If you look at the column that's kind of in the middle, it's got a lot of red. That's the personal fund expense ratio. If it's red, what that's telling you is it's much more expensive than what they consider the norm for that type of strategy. If it's yellow, it's kind of okay. It's a reasonable fee. If it's green, it's positive relative to other funds that are of the similar type of strategy. So as you can see, a lot of red. The management fee in this particular client's case is 0.5%. That's below the norm. Quite frankly, an advisor usually charges 1 to 1 1/4, the price that you saw. Some of them do charge 2. Some of them charge 2 1/4, and as you saw, even up to 2.75. Anyway, in this case, the particular advisor is charging a reasonable fee. Down at the bottom, if you look over to the right first, you'll see the total value of this portfolio is quote unquote only $311,000. I only say the word only because look at the fees. They're paying $8,347. Now, my point a few minutes ago was personal fund is analyzing the expense ratio. They have not factored in all these additional costs that I just showed you that the Forbes article uncovered. So figure this is a good case for the client. It's not even the worst case. Maybe it's not even reality as far as it's probably much higher than this. But even at that, if you look at the prices, so $8,347 are paying in fees. Now, if you go over to the left-hand side, we've compared it to a few different ways that you could approach the exact same risk profile, buying exactly the same allocation, just using different type of security to accomplish this. The first one, self-managed ETFs. That's assuming that you have the time and knowledge to do it yourself. And if you do, God bless you, you could pay about 0.25% would be your fee. And as you see there, if that's the case, your fee would be about $778. You would save close to $7,600 in fees on a $311,000 portfolio. I mean, that's huge money. If you hire an advisor to help you that has access and believes in this type of management style, we say 1.41%. The fees would be about $4,400. You'd still save close to $4,000 hiring an advisor that is looking out for your best interest. If you did an annuity only, and I'm not suggesting that you would necessarily, but for those that are big on annuities, back it's 0.25%, excuse me. You save your $7,600. If you did an annuity ETF combo, now you're looking at savings of close to $6,000. And there's further discussions one has to have about how those combos work. They make sense for folks, but you have to analyze the individual. Each case is its own case as far as the clients. Sample number 2, go through this one real quickly. As you can see, this one is held at a bank. A lot of red on that screen. Let's look over at the bottom right-hand corner. This is a $400,000 portfolio. The savings, if they went self-managed, would be $16,000. If they hire an advisor who believes in this style of management, they would save $11,500. So I won't go through all the numbers. You can certainly read it yourself. And by the way, this webinar will be available after the broadcast for you to look at in more depth. But these are real accounts that I have with clients at this very moment. This is not something we just put together and said, hey, this looks great. Let's use this for the webinar. This is real stuff. And you can be assured that these people are making the change, not necessarily, again, to their risk profile, just using a different way of getting there. This is just disclosure stuff. Again, read that at your leisure, but it relates to the pages that you just saw. Some folks asked me, in fact, Toby asked me, he said, well, Dave, what does that mean? I mean, a lot of numbers and stuff. Could we look at it from a different angle? So I went out and I did some research and found a group that does exactly that. And what they did is they have a case study here. It's a 22-year-old recent college graduate, makes $50,000 a year and invests 10% a year. Now, I haven't adjusted for inflation, for raises, etc. I just said that's what he's going to make forever, and So he's going to invest $5,000 a year. What would that effect be on the retirement age? Something that means, beyond money is tangible to us in years, if you will. And the example he used was the 0.18%. That's probably a little bit low versus the 0.25%, but it's in the ballpark. Again, that's saying if you manage your own portfolio and you were this individual, arguably you could retire at 56 years old. If you paid a little bit more, maybe bought some strategies that are just a tiny bit more expensive, maybe 0.4%, maybe 0.5%, if you will. It doesn't go up that much, but again, you're still managing it yourself, but now you can retire at 57. If you hire someone to work with you and manage these portfolios for you, and hopefully get you out of the way of train wrecks when they're coming down the track and so on and so forth, obviously a few years older, but still 61 years old, versus if you pay the standard rate. Now, 275, you remember the number I gave you a minute ago, 582. I'm not even half of that. And that's still saying that you've just added 10 years of retirement age on just by how you pay your fees or how much you pay in fees.
Mm-hmm.
So that's huge.
Yeah, it looks like you're talking about you'd be adding another 10 years or so just by going to the wrong institution.
Yeah, because you would, if we put that in at 582 instead of 275, you'd be retiring at 75 years old probably if we took that out.
Ouch.
I looked at it. Everybody is different. Some people like charts. Some people like what we did just a second ago. Here's a comparison, just so you can kind of see how the numbers work out. For people that like graphs, there's a nice graph at the top. But if you look at the bottom line, fee number one, that's the 0.18%, the do-it-yourself version. That suggests if you do exactly what this young man was going to do, $5,000 up front, $5,000 a year. We said the return would be about 7%. 7% is a fair return for the market, if you will, over time. So that's not an unreasonably high or low return. It suggests that they would have contributed, obviously, in all cases, $155,000. But in fee number one, they now would have $524,653. Second fee, which is the one that you hire somebody, you've got $415,000. The third fee, where you hire someone, but they're charging, not totally unreasonable rates, but pretty high, $322,000. I mean, huge difference. You're talking $200,000 difference between fee number one and fee number three. So for those that like looking at those numbers, there's a quick glance. This is it's kind of black gallows humor here, where you kind of look at it and go, it's Granny down at the mall. I guess we all get approached by these survey people, and the gentleman's apparently just walked up the pollster and says, "So, ma'am, what's your outlook on the economy?" She says, "What's my outlook on the economy? I'm out looking for a job." And unfortunately, that for a lot of folks today is our reality. Bottom line, as I say here, remember, fees are something you can help control. The market you can't control. The how long you live, you can control it. You can make sure you don't live as long if you want to do some things to your body, of course. But for the most part, all these things, the other variables, are very difficult for you to control. Fees is one area of your portfolio management you certainly can.
Mm-hmm.
Here's our disclosure. I am not an attorney. Toby Mathis is, so I'm not representing this as a licensed lawyer, nor am I a CPA. I am a certified financial planner, which is different than a CPA. But we do talk about taxes, and I do bring in professionals at this firm, be it Toby or the CPAs on staff.
David, what's the goal here? I mean, go back a couple slides to where we're looking at the numbers. So, what are you going to do? Because I know that the offer is a freebie, which is, let's take a look at your portfolio. What are you going to do? So when you showed the clients, let's even go back another few slides to where you actually went through a portfolio. Right there. Okay. So you looked at that client and you saw that they were paying $17,000 a year in fees.
Right.
They were paying 4.29, and that's just when we did the earlier analysis. There was two portions of that. There was about 4%, and then there was another 2%. That was bringing it up to about that 6%, just below 6%, the 5 point whatever it was. 582. So this is the underlying. There's another component to this, but what do? You break it down and you look in, you figure out what it is they're actually paying.
Yeah, we go through personalfund.com. We like doing unbiased analysis of things. We think that's the appropriate way to do it. Let's not make it Dave's decision. Let's make it an outside party, a third party. We put in the actual portfolio that somebody, if they wanted it analyzed, what they actually have. We come up with a cost as per the analysis that personalfunders.com has come up with. And then we give the different versions on the left-hand side of what you could do if you chose to take a different approach to things.
Right, and so like a different version would be when you say managed ETFs. So let's just hit that one for a second. So what you would do is you would actually take them into the same stock sometimes, but instead of doing a mutual fund, you would do a group of stock in an ETF. Is that what that is?
Yeah, I mean, there's a lot of ways that different advisors will do it. I'm not much for the really wild and crazy ETFs. You know, there's 1,500 ETFs right now out there, exchange transferred funds, for those folks that are wondering what that acronym means. Exchange transferred funds, that is the tool, in my estimation, in my belief, we should be considering today. It's going to replace mutual funds, and here's why. First of all, a mutual fund, when you buy a mutual fund, you don't know what you bought. They never tell you 100% of the holdings. They tell you the top 10 holdings at best. By regulation, an ETF has to tell you within 15 minutes of trading 100% of the holdings in an ETF at any time.
In an ETF, it's just stocks.
It depends. It could be bonds. It could be other strategies. They could run shorts. There's a lot.
But it's just a grouping. It's immediately invested. It's not like it's a fund sitting there with a bunch of money in it.
No, they go out and they buy whatever's necessary. You know, as they get more money in today.
So Spider's the most common.
Yeah, Spider was invented in 1993. The first one was invented in Toronto, Canada in 1989. It was called the TIP 35. But Spider is the one that most people are familiar with, and that basically represents the S&P 500.
Okay.
So if somebody said, I want the S&P 500 exposure, instead of going out and buying a whole bunch of individual stocks, they'd buy a Spider, or an SPY.
And that's okay. And that's just an ETF.
Yeah.
Okay. So that's just one way of looking at it. Okay.
Yeah. And so, you know, when they do that, the other advantages of ETFs is you saw what it costs for a mutual fund. A Spider, for instance, costs 0.1%. You can't compare as far as if I buy a Spider that represents the S&P 500, I buy a mutual fund that represents the S&P 500, I'd probably say 3% right off the top just in the fee.
So what you would do for somebody is they would say, here's my portfolio. You'd break it down and say, here's what you're actually paying. You could move it over into something.
We could move it if somebody said, wow, that's great. Could you now implement this for me? Yes, we have parties that we work through that actually manage portfolios that do exactly this. And the theory is people will say, well, I want to buy some stocks. And we don't buy stocks here. We're not licensed to do it. I have been licensed to do it. But quite frankly, here's the thing.
Yeah, why do it?
If you own Exxon, Conoco, BP, individual stocks, as the oil or as the petroleum market goes, the petroleum market goes. Wouldn't it make more sense to buy an ETF? An ETF, typically, just for information purposes, has, depending on which type of ETF, 50 to 250 instruments attached to it. And we call these long-only ETFs. In other words, these are ETFs that represent a basket of securities. So you're getting broader diversification, yet you only have one security on your statement. So you could go out and buy 150 stocks, or you can buy one ETF that represents those 150 stocks. And in my opinion, think about trading costs alone. When they trade that ETF, they trade one instrument. You got to go and sell your whole portfolio. You got to sell 150 stocks. So your trading costs are much less. The cost of the individual instrument itself is well below the cost of the mutual fund. The full transparency. The thing is, too, they're traded during the day. Now, some people said, well, that was a problem. We had a flash crash back in May of 2010. The ETFs as such didn't cause the flash crash. What caused the flash crash was high-frequency traders that had computer programs that somebody triggered something over here that caused a bunch of things to happen. And they've put in fact, actually, all those trades, for the most part, were reversed. They would not allow them to go through because people were could have lost 60%. Well, that was all caused by computers. They've made that work much more efficiently these days. But the ETF is going to replace the mutual fund because why wouldn't it? When you think of all the benefits it has, low cost, transparency, easy to trade, broader diversification, all in one instrument, a mutual fund makes no sense.
Okay, I didn't mean to steal your thunder. Now go to the slide where they can use you for their cost benefit analysis. Because guys, this is going to be free. So this isn't going to cost you a dime to do a cost benefit analysis. As part on the website, there should be a submission form where you can just leave your name and I think it's probably email and maybe a phone number. where you can actually have a cost benefit analysis prepared by Dave and his team. And what all they're going to do is look and see how much you're paying and how much they can save. Then you could say, you know what? Yeah, implement this. It's going to save me $7,000 a year.
Yeah.
That's it. I mean, it's literally, that's how black and white it is. It's one of those things where you're saying, either I can keep paying my 7% or 6% or 5%, whatever it is, or I could have these guys create the plan for me, implement it, and immediately increase my, how much I'm bringing to my bottom line by that much money. And in the cases, just the two examples we just showed you, but I know from experience that there's a few more that you've worked on.
Yeah,
that are
we've had so many people that have come to us, and it's the savings. Basically, what we do is we do the cost benefit analysis, and if you say, "Wow, I want you to help me, fix this," if that's the right word, what I do as a certified financial planner, what we'll talk about next, would be us doing a comprehensive financial plan. Because to do the best work for you, to do things that are in your best interest, the best way to do that is make sure we know exactly what you have going on, because the last thing in the world you need somebody doing on your behalf is something over in the left-hand side of your portfolio that's offsetting or harming something on the right-hand side. So we get to know each other if we get to that stage, and but at a minimum, the cost-benefit analysis, you can go back to your other providers you have now and just say, look, I want you to do this. Most of them probably won't, because quite frankly, it's not in their best interest.
Yeah, if they've been taking the 20s out of your back pocket while you've been walking down the street, why would you go up to that person and say, hey, I just figured out you've been taking the 20s out of my pocket. Could you please stop? And keep using you for other things because you're so trustworthy. No, it's like, make it stop. Just quit paying it if you don't have to, because that's going to make you spend a lot more years waiting for retirement. And this is personal for me. This is very personal for me because I had my mom go through this. Mom and dad, dad passed last year, but they were mutual fund people, and I would gripe all the time. And it was amazing at how much the actual expenses were. And these guys would swear up and down how great it was. And they got hammered in the market downturn. And of course, these people still made money. And they're always like, yeah, it's real unfortunate. We'll just wait it out. And they're still waiting.
Unfortunately.
It's like just waiting for time. So this is one of those things that it's kind of a no-brainer. We try to make it to where there's nothing to lose. It's just figure out exactly how much it's costing. I don't care whether it's a $50,000 account or a $5 million account. The amount that you could be overpaying is significant. And even if you're overpaying $2,000 a year in a $50,000 account, that's pretty material. That's a big chunk of change in my book, period. And if you can avoid it, avoid it. And a lot of times it's doing nothing more than just moving it over and buying the ETF as opposed to having it sitting in a mutual fund where somebody's bilking your money. Dave, is there anything else you want to hit on?
No, I think that's it. As I say, this is for educational purposes. I've lived on the other side of the street. I was part of the other side of the street. I got out of the banking side of the business over a decade now, and part of my frustration was being a certified financial planner, going to these meetings as a senior bank executive. It wasn't balancing. When you tell your employees you got to sell a product or else, and then you turn around and tell the client we're doing the best thing for you, it doesn't make sense. It just wasn't working. So I'm happy to be here, part of Anderson, where I can be a lot more objective about things. All the work we do, as you saw, a lot of the slides, even the presentations we do, the software we use outside parties that are really good at what they do. Our opinion is we should always be providing best of class solutions to our clients, and not just stuff Dave likes. Mm-hmm. I don't care if I go on a cruise. Any strategies that we work with people, if we're asked to implement them, I go to a third party. I go on top of everything else. I still go to a third party and say, I have a case that looks like this. What do you think is the best strategy? And if it's not who I used last week, then it's not who I used last week, because every client is an individual. Every family is an individual family. They need to be treated as such. So everything we do is customized here. There's nothing off the shelf.
Fantastic. All right. So thanks for joining us for the webinar. Something you can do is share this. It's going to be posted on the site as soon as we're done. Share it with anybody that you think could benefit from it. Let's get the information out. The reason that we've seen this explosion of these mutual funds is because they're making so much flipping money on these things. The reason that you see Wall Street just continuing to act with kind of a reckless disregard towards the public is because they're making so much money. They seem to control the laws, the politicians. It's not a secret. If we want to get people to start making positive changes so that they're not at least they're going in with their eyes open if they want to do these things, at least get them to where they're educated, at least get it to where they have an idea and that they're not just doing it blind and they're not being misled without having knowledge. And so share it with anybody you want, put it out there. And if you're like me, I always bug my mom, bug your mom, bug your dad, bug your uncle, and just say, hey, could you have somebody take a look at it and make sure that you're not putting the retirement plan that should be for you into your broker's pocket. Anyway, that's it. Thanks for joining us. Until next time, this is Dave McShane and Toby Mathis. Thanks for joining us for this Anderson webinar.
Thanks.